All right. Thanks, everyone, for joining us today. We're going to be covering how to maximize your retirement contributions into different retirement accounts, all ones that can be self-directed, and we'll cover some of the different aspects of each one of the plans, different rules that go along with them, especially maintaining a good portion of the time for the actual small business plans, so the SEP, Simple, and Solo 401k. A little bit about myself. My name is Alex Perney. I'm a certified IRA services professional here with Advanta IRA. Been here for just at 5 years, so I've been doing this for a while. I have a good base of knowledge. I started out in doing transactions for us and have moved into a role of doing education and business development for Advanta. So before we get started, just so everyone is aware, our required disclaimer, we do not provide any legal or tax advice or investment advice or products. All the information we're going to provide here today is for informational purposes only. I would encourage any and all parties before entering into a financial decision or any type of financial arrangement to consult a qualified person such as a tax attorney, regular attorney, or CPA that can advise you on what you are trying to do. Before we get too far into this, just for the people that are just joining us, please make sure you do type in all of your questions. Everyone's microphone is muted and the raise hand function is turned off, so please make sure that you do just type the questions in if you do have them. If you do have any further questions or you'd like to get some additional information going on past our presentation today, we do maintain a great learning center on our website that is complete with up-to-date events, all of our on-demand things. So what we will do at the end of this presentation, we will upload all of these slides and information along with the recording to our YouTube channel. So if you'd like to go back through and listen to it again or kind of take some more notes, you can certainly do that at any time you'd like, free of charge. And we also maintain an up-to-date blog that covers topics that are specifically related to the retirement community with specific regard to retirement planning and different types of investing in qualified accounts. With regards to any of these accounts, the ease of starting is definitely there. So we have a very simplified process, and since we've just gotten onboarded with DocuSign, the way that this goes for any type of plan we'll cover is that in order to get started with investing, you just simply first need to open the account, fund the account. Specifically, we'll be covering the earned income contribution and employer match contributions of these types of plans today. And then you start investing. So really there isn't too much that goes in the way of roadblocks or any sort of, large technical aspects that are involved with establishing these types of plans or accounts. It's very streamlined and fairly straightforward. Now, with regards to our role in self-directed these types of accounts, we are the administrator of the account, and we hold the records of any and all assets that are held within. The term self-direction is oftentimes used in a lot more context than what we actually focus on. We focus on true self-direction of giving you as the client or the individual the ability to go out, select, and find the investment that you're knowledgeable and comfortable with in order to make a very well-informed decision on your retirement assets. We don't offer any sort of tax or legal or investment advice on these, so we allow you to bring us the investment so that we can structure it underneath of your account in the correct way per IRS guidelines. So what does this mean? It means that your IRAs, 401ks, solo Ks, SEP IRAs, and simple IRAs can hold a much broader variety of investments than just your typical stocks, bonds, and mutual funds. You're going to be able to open up the door to investing in things like titled real estate, mortgages, notes, private equity in companies like startups or other type of private stock offerings such as private and local banks, foreign currency, options, and really the list goes on and on. We can and we do have presentations that are just centered on the different aspects of what you can and can't invest in with these accounts because the scope of it's so broad. To enumerate a little bit on the real estate and types of assets that people purchase within these types of plans, we just like to put this up here so that people understand that it's not just certain types of real estate, which is what a lot of people are focused on with self-directing their IRA. It can really span everything from notes and mortgages to rentals. You can do rehabs, tax liens. You can buy things for appreciable value such as raw land and also get into things like duplexes and mobile homes. It's not simply just going to be limited to the very narrow band of things that people most often are associating with doing when it comes to real estate itself. With that said, here's the kind of self-directed plans that we're going to be covering today. So we have the traditional and Roth IRA. The traditional IRA was established in 1975 with the passing of ERISA, which also brought into account individual 401k plans, which kind of level the playing field for large pensions, such as the United Auto Workers and other people, for smaller businesses and individuals to have tax-deductible contributions into a plan and be able to get tax-deferred earnings in that plan as well. Now, that's all well and good, but there's a very narrow scope that's covered there. Now, throughout the years, we've had several different iterations of these different types of plans. If anyone that's on here is old enough to remember, maybe a little bit more antiquated KEO plan, SARSEPs. Then coming into the mid-90s, we had the advent of the Simple IRA, and then the newer version of that being the SEP IRA, the individual 401k plan coming into existence around the same time, really giving the individuals the ability to control and best utilize the way that they are paying themselves in a small business situation to maximize their contributions into these plans and also get the best type of returns that they're looking for. So with these types of plans, we like to start out with the very most basic ones that everyone is inherently very familiar with. We have our traditional and our Roth IRAs. The traditional IRA is going to be a tax-deductible contribution plan. So anyone that has earned income, now this can be a small business owner, this can be a individual working for a large company, it can be the spouse of someone that has earned income as well. Because the nice thing with the traditional and Roth IRA is that if you are married filing jointly and there is a primary breadwinner of the family, that person that if they are filing jointly that is not currently employed or making earned income, which is defined by anything that is going to be on Schedule C of your 1040 tax return, can actually contribute into a plan and get those tax-deferred earnings and also take a deduction with a traditional IRA on their joint filing tax return. So with that said, it does have to be earned income. Individuals that are under the age of 50 and a half have the ability to contribute $5,500 into the plan, and individuals that are over $6,500, over 50 and a half, can contribute $6,500. This is called your retirement catch-up that the IRS has deemed, so you have the extra $1,000 for individuals over the age of 50 and a half. Now, keep in mind, this is going to be separate from the age of 59 and a half, at which point you can take penalty-free distributions from both traditional and Roth accounts. With the traditional and Roth account, the $5,500 or $6,500 is going to be an aggregate total of everything that you have contributed annually for that type of plan. So if you have 3 IRAs, you can't contribute $5,500 to each of them. You can only contribute a total of $5,500 across all of them, or of course $6,500 over the entirety of your accounts that you have if you're over 50 and a half. Now, some people may have passive income. Maybe they are being paid via just rental income, or they are just subsiding on interest income from dividends or stocks. Now, these people don't necessarily preclude themselves from being able to contribute to these plans. The nice thing about a traditional and a Roth IRA is that you have the ability to make a 100% earned income contribution into the plan, meaning that let's say you only paid yourself $5,500 of earned income in that taxable year. Well, you can take that entire $5,500 or $6,500 if you're over 50 and a half and put that into an IRA. If you have much greater income streams derived from passive income like rental or dividends or interest, you can utilize that to live on. And then the other portion of that that is deemed earned income on your Schedule C of your 1040 can be wholly contributed into the plan. The nice thing is that you can create a additional deduction if you're making it to a traditional IRA, or if you're in a very low tax bracket with getting passive income, making it as a Roth contribution and taking no deduction for that. Now, some of the rules that are related to the traditional and Roth IRA, one that is very important for people, especially right now, to understand is that you can still make a previous year contribution if you establish a traditional or Roth IRA before your timely filing deadline. Now, you will hear me mention timely and extended filing deadlines here a couple times because they do differ in the types of plans for the ability to make a contribution for previous year. traditional and Roth IRAs, the individual IRA plans, have the caveat that you can establish the plan after the taxable year is ended and still make a contribution for the previous year. But you only have until your personal timely filing deadline of April 15th or the next applicable date, which I do believe is the 16th or 17th this year. So your timely filing deadline in order to make that contribution. Even if you do file for an extension, the individual traditional and Roth IRAs do not allow for a previous year contribution made up until October 16th for the filing extension deadline. Now, the interesting thing with these types of plans is that they are completely portable. You can have multiple types, you can have multiple IRAs, multiple Roth IRAs at different places. Granted, you can only make certain amounts of contributions to each, but you can spread out your IRAs over many different platforms in order to take advantage of different types of investments. Now, all of these IRAs can in turn be funneled into traditional or Roth IRAs just so long as the tax benefits on them are the same. So you can combine your IRAs across platforms. You can spread them out, combine them depending on what your strategy is to try to take advantage of different types of investments. Now, this is an important note to remember because you cannot have multiple different types of certain business accounts, such as a simple IRA. If you have a simple IRA, you're precluded from being covered by any other simple plan. Even if you are employed by multiple employers that are offering simple plans, you can only choose one of those employers to be covered under that plan of. So just a good little bit of information to remember is that you only are able to have certain types of plans if you are not covered by other types of retirement plans. And just as a reminder to everyone, if you do hear something that you would like some clarification on or an additional clarity, please type in the questions. Again, the raise hand function is turned off, and the audio for everyone's microphone is turned off, so please do type in the questions, and I'll address them throughout the presentation. Now, the SEP IRA. The SEP IRA is essentially the newest version of the Simple IRA. It stands for Simplified Employer Pension IRA. Now, the contributions for this type of plan are going to be increased against the COLAs, which is the cost of living adjustment for 2017. The total compensation that can be added into a SEP IRA for 2017 is now going to be $54,000 as opposed to $53,000, which was the contribution limits for 2016, 2015, and 2014. Now, the way that you calculate the SEP IRA contribution is that you can contribute up to a certain percentage of an individual's salary into the plan. Now, that is going to be 20% of base compensation, and that is going to max out at $270K for the employee. Now, the interesting thing about this is that you are deferring a part of the compensation of the employee, so you are actually reducing the amount that they are taking as a taxable income. So the individual, and if you're an individual business owner, you are going to reduce the amount of income that you have. So you're going to be essentially be paying less taxes. Your company will be getting a deduction for the amount of money that they are adding in there. So you're creating a corporate deduction, and if you're maxing it out, it's going to be $54,000 or $53,000, depending on the year that you're making that contribution. And the other interesting thing about this is that you have the ability in this type of plan to establish a SEP up until your filing deadline and make a previous year contribution. So you still do have time for this type of business plan in order to make a contribution for a previous year. Now, the other types of plans we cover, unfortunately, you would have had to establish it already within that taxable year, but you can also still contribute to them this year. You just cannot do it retroactively for previous years. So the big power of the SEP is that you do have your ability to establish and then also contribute to a plan that was not established within the taxable year that you are looking to make that for. Okay, we have a question coming in. What is the maximum contribution to open either a traditional or Roth account? The maximum contribution limits for 2017 and 2016 are $5,500 for individuals under the age of 50 and a half and $6,500 for individuals over the age of 50 and a half. So there's a little bit of interesting calculations that have to be done with the SEP IRA specifically. Now, it's not just as easy as saying, okay, I have X amount of compensation that I'm being paid. I'm going to make that make that as a contribution into my SEP plan according to the calculations and rules of 20% of base compensation. You do have to look at it from the perspective of self-employed individuals have to calculate contributions less 1/2 of the self-employment tax that they are paying. So you do have additional calculations that you are going to be looking at with regards to trying to either maximize or fully calculate what your SEP contribution can be from the company that you've established the SEP plan for. A very interesting thing about the SEP plans is that you are not locked into making contributions each year. You can, since it all is going to be essentially an elective deferral of compensation out of the plan, out of the compensation that you are making, the individual employee really gets to determine how much they're going to be contributing into the plan on an annualized basis. So it's nice from that fact. Let's say you have a year where you need to pay a higher salary to yourself as an individual business owner, you can increase the amount that you are going to be deferring out of your compensation up to the 20% gross limit. But let's say you had a year where you paid significantly less because you wanted to keep more money cyclical on the side of the business for whatever reason. You can adjust those on an annual basis and not be locked into something like you are with a simple IRA, where you do have a testing limit for 2 years that you have to maintain any sort of elective deferral contributions being made on behalf of the employer into the plan, unless you're wanting to face penalties underneath of that plan document rule. Now, with the SEP IRA, there is a little bit of extra paperwork that has to be done. As opposed to just a traditional or Roth IRA, you also have a component called a 5305 that has to be done along with this type of plan. It's a prototype document that we provide to you. Just needs to be filled out and covers who can and can't be covered underneath the plan, whom the manager is, and just as a small tidbit of information, anyone that is over the age of 21 that is working full-time for a company offering a SEP plan has to be extended and covered underneath of that SEP plan as well. So there are exclusionary rules for these types of plans that do need to be considered, but the big important thing for maximizing your contributions into this type of plan is that you do have time. A lot of the stuff that we cover is very based on certain dates and times throughout the year. The SEP plan has the great carve out that you still have time in order to establish one and get a contribution into one in order to help maybe reduce the amount of money that you're going to be owing in taxes for the taxable year of 2016. And the main reason for this is that the elective deferral of compensation, especially for self-employed individuals, may not be known until the very end of the year, and especially since it's going to be a corporate deduction, the IRS likes to give a little bit of extra time to companies in order to make sure that they are properly filing their taxes with regards to any compensation deferrals that are being made at the end of the year or after the first of the year into that plan. So, the individual 401k has been gaining a lot of traction with people lately, and there are many reasons why people really do like this plan. The big benefit of this plan is that you kind of get to have the best of both worlds with regards to maximizing your contributions. With the SEP plan, you are creating solely just a corporate deduction. Now, you do have your traditional IRA contribution you can make, so potentially you can make $5,500 or $6,500 of deductible contribution into a SEP plan, but there really isn't any additional benefit for personal deduction with a SEP plan over a traditional or Roth IRA. They're more or less the same for your personal contributions. The individual 401k kind of turns that on its head. So you have a much greater amount of personal deduction you get to make because the actual amount of money that's being contributed into the plan is coming from two different places. So with regards to an individual 401k, you're basing the amount of money that you are adding it into it on two different things. The first thing is your elective deferral of compensation. So in this plan, instead of saying that you are going to defer your compensation on the corporate side of things, you're actually going to be getting paid the money. You're going to be claiming it on Schedule C of your 1040 or in certain instances maybe on Schedule E. But for the most part, we're going to be concerned with Schedule C earned income of the employee, or in an individual business owner sense, the sole proprietor or sole shareholder of the subchapter S corporation. So you're going to be able to defer up to $18,000 of that money. So you get the money and then you say, okay, then I'm going to defer that into the plan, which creates a personal deduction for you as the employee. Now, that $18,000 is the cap if you are under the age of 50 and a half. If you are over the age of 50 and a half, you get a great additional bump of $6,000 of being able to electively defer into that plan on an annualized basis. So you can create potentially $24,000 of deduction within that for this plan personally. Now, again, the nice thing with the individual 401k is that you can do this as a 100% contribution of compensation. So long as you're being paid commensurate with $18,000 or $24,000, you can make your elected deferral of that amount of money and then be just fine. You don't necessarily have to do any sort of calculation of a certain percentage of the amount of money that you are being paid can be put in there. Now, the other portion of this is going to be the profit sharing match. So this is going to be similar to what we covered as the SEP contribution. This is going to create a deduction for the company. Now, the max out best case scenario for being able to contribute into a 401k plan for your profit sharing match is going to be $35,000, which does have a cap ratio on it in that it cannot be over 20% of the net business income. So if your company only made total $100,000, paid you $24,000, it can't make a $35,000 profit sharing match into that plan. You do have to make sure that you are staying within the boundaries of that 20% net business income for your elected deferral contribution, or for your profit sharing match contribution. The cool thing is that you can, especially as a individual 401k business owner, you can change the amounts and the ratios that you're contributing. So if you want to have your company contribute less of a profit sharing match on an annual basis, you can make your elective deferral contribution into that plan as well without having to worry about keeping ratios static with regards to how much you're contributing into that plan on behalf of the business. Now, probably the big thing that gets a lot of people with this is that your elective deferral, the contributions that you are making out of your own pocket, so Alex gets paid a certain amount of money, I contribute into my 401k plan, you can make that as either a deductible contribution, so as a traditional contribution, or as a Roth contribution. So the cool thing about this is that potentially, and depending on how much of a deduction the person needs, you can be making $18,000 or $24,000 of Roth contribution per year into this plan, which is certainly much more attractive than the $5,500 that is capped for the Roth IRA. You can really start to get a lot of tax-free growth with this type of plan because you have the ability to make Roth contributions into the plan. And especially if your plan document allows it, you can also do Roth conversions. So if you want to take a heavier tax burden personally and convert the safe harbor match, the profit sharing match of up to $35,000 within that plan as well, you can potentially get the full vested balance into a Roth per year, but keep in mind that you are going to be seeing large tax hits for that. It's not for everyone. Do check with your CPA when it comes to doing things with regards to Roth conversions of plans, as you will be getting very large tax bills at the end of the year, but it's just definitely something to look at as far as ways to maximize your contributions, maximize your tax-free growth, and also the different caveats that go into these plans, because it's not just as simple as looking at a number of 18 to 24 and 35 of profit sharing. There's a lot of cool stuff that goes in there, and when we talk about maximizing contributions, we're not just talking about maximizing the amount of money you put in there. We also need to take a look at maximizing your growth and what parts of the growth that you want to be tax-free or tax-deferred. So especially with small business plans, you do have a lot more options than you do with the traditional or Roth IRA. So it's really good to look at all of the different rules on the plan, because if you miss something, like being able to make your elective deferral as a Roth contribution, you might be missing out on a lot of opportunity there. So if your strategy allows for it and your personal tax bill allows for it, keep in mind that that could be a very interesting route to go. Now, it's not all good things with with regards to the individual 401k. The amount of money you can add into it is fantastic, and the ability to do a Roth is awesome as well. But the solo 401k does have restrictions with who you can and can't cover. Now, if you're an individual business owner and it's just you and your spouse, you can absolutely be covered by an individual 401k plan. Now, let's say it's you, your spouse, and a business partner, or four business partners that all own an equity interest in the business. You can all be covered under an individual 401k plan. But let's say you have one rank and file employee that is a W-2 employee, the solo 401k or individual 401k can no longer cover that business. The reason is that there are a lot of rules regarding discrimination of employees with regards to being covered by an employee benefit plan such as a 401k. Now, the IRS mandates that you have to do things such as called discrimination testing and also plan testing to make sure everyone that is eligible underneath of the company is being offered the plan. Now, if you have rank and file employees, that's where this kind of comes into. If everyone is an equitable owner of the company or it's your spouse, they're going to be offered the plan by virtue of the fact that they own a part of the business. Now, you don't have to, look too much farther into that, but just to be aware that this plan does not scale as easily as a set plan might scale. So if you are someone that has a few rank and file employees, you have some people that work for you part-time or something like that, the SEP plan is going to scale a lot easier and cheaper than a 401k plan would. So depending on how you'd like to maximize the contributions, if your cost basis is something that you factor into a lot, then the SEP plan might be a better route to go. But if you really do want to get tax-free growth and you do qualify for the individual 401k or can handle the additional cost of doing testing for the plan, the 401k might inherently be the much better option for you. Now, the one downside, especially at this time of year, to the 401k specifically, is that you did have to establish the plan between between January 1 and December 31 of the taxable year in which you would like to make the contribution for that plan. So unfortunately for individuals looking to try to reduce their 2016 tax bill, the time has passed for being able to establish an individual 401k for that year. Now, you can certainly establish one this year, make your contributions into it, and go forward, but you can't retroactively go back like you can with a SEP plan in order to contribute additional monies for 2016 into that plan. Okay, now, I do like to cover the simple IRA because they do have their place in the retirement arena. Now, it is certainly a more antiquated plan. They are not as in favor as much as they once were because the SEP IRA is a lot easier to administer and typically costs a little bit less to administer as well, especially with the much more dynamic marketplace that a lot of small business owners operate in. The SEP IRA gives you a lot more flexibility with regards to how much you're contributing into the plan on each year, your flexibility with dissolving the plan, as well as being able to change the amount of money that the company is going to be on the hook for contributing on an annual basis. So with a simple IRA, we're looking at your contributions on a scale that's much more similar to the individual 401k. You have two different parts of this plan. You have an elective deferral of the compensation of the employee, and you also have a match of the employer into the plan as well. However, it is not a profit-sharing match necessarily that you are looking at so much with a simple IRA as it is two different elections that you have, and we'll get into those in a moment. The contribution limits for your simple elective deferral, so what you're taking out of your personal paycheck and putting into the plan on an annual basis, is going to be $12,500 per year per employee that are covered under the plan. And if the employee is over the age of 50, you have an additional $3,000 catch-up. So you're looking at $15,500 potentially if you are over the age of 50. That is an elective deferral, personally deductible contribution that you are going to be making into the simple plan. So you do have that aspect that is very similar to the individual 401k. The individual 401ks and personal contributions are significantly higher. So whereas you're maxing out over 50 at $15,500 with the simple IRA, you're going to be maxing out at $24,000 with the individual 401k with your elective deferral of compensation. Now, with a simple IRA, you do not have the ability to make that contribution of the $12,500 or $15,500 as a Roth contribution. You have to make it as a deductible pre-tax contribution into the plan. There is no sort of carve-out or caveat for having a simple Roth IRA. It's just the way that the plans were written, and they were written into an existence around the same time, if not a little bit before the actual Roth IRA came into being as well. So the company in this aspect has the other portion of contribution that they're making. Now, the company has choices here. So for some people that don't like to calculate on net income of the business, you have some different options with a simple IRA. You can either contribute 2% non-elective deferral to each employee of the company, so meaning that you're taking a profit sharing essentially of the company of 2% of the net operating income and contributing it to the plan for each employee. Now, the issue with this is that you are going to be locked into this for at least 2 years once you have made the election of the plan in order to change any type of contribution that is being made into the plan on behalf of the company. Now, for individual business owners, that can really kind of be a hindrance because if you work in a very dynamic marketplace, the buckets essentially that you're going to be pulling money from in order to contribute into these plans can change drastically from year to year. So if you're making a profit sharing match 1 year, that might inherently be something that you don't have as much profits the next year, so you'd rather be making something that is based more on the compensation of the employee. So if the compensation of the employee fluctuates from year to year and you're tied to a 3% matching of each employee's compensation, you're going to be able to scale that plan back a little bit with regards to how much money is being contributed on behalf of the company for each employee, but you're still going to be locked into either a 2% non-elective deferral of profits into the plan for each employee or a 3% matching of each employee's compensation into the plan as well. Now, this plan needs to be established by year's end in order to make a contribution into it. There actually is some more specific details of that. The actual plan does need to be established a little bit before the end of the year in order to be able to be contributed in after the first. So with regards to simple IRAs, the mark has passed for being able to contribute money into them for a previous year contribution. Now, with this type of plan, unlike the individual 401k, the SEP IRA, and the traditional and Roth IRAs, the rules do cover a little bit different with this in that if you are being covered and making contributions to a simple plan, you cannot be covered by any other simple plan. So it doesn't make so much of a difference for the individual business owner or anyone that might be a very small business owner, but for people that maybe have more than one job or do work 2 full-time jobs, you can't be covered under 2 different simple plans. Now, you don't have to be a full-time employee to be covered under a simple, so even if you are working part-time, unfortunately, if the only retirement plan that's being offered by your employer is a simple, you can't be covered by both of them and be able to make contributions. Now, the other restriction for simple plans is that you cannot transfer or roll out of the plan for a period of at least 2 years. So once you have made the election to start being covered and make elective deferral compensations of the $12,500 or $15,500 into the plan, you're going to be locked into that plan and not be able to do any sort of aggregate rollout changes unless you've been terminated of employment for at least 2 years. All employees that make over $5,000 per year have to be included with the simple plan coverage. Now, you can be a little bit different with regards to the coverage in a SEP IRA insofar as that you do have the election of being able to exclude certain people that are below the age of 21 from that plan coverage, but anyone that is making W-2 income from that company at or above $5,000 has to be covered by the plan, and that's also going to kick into you having to make contributions into that plan, as we covered before, by either the 2% of non-elective contribution of the employee's compensation to the plan, or for 3% matching scaled with the compensation of the plan for that employee. So there are a lot of regulations and rules with regards to simples. So just be aware if the 401k may not work for you because you have multiple employees, the SEP IRA doesn't necessarily work for you because maybe let's say you have um, you don't have as much profits to, or you don't have as much profits to be able to add into that, so you can't afford to make sizable contributions based on compensation. You'd like to split it up a little bit. The simple IRA still does have a place, in that it is kind of the bridge gap between the SEP IRA and the individual 401k. But again, typically we can most of the time find a good happy medium with regards to one of those two types of plans being a better fit than the simple. But they are still out. You still can open one, but unfortunately you cannot make a previous year contribution into that plan by establishing the plan in this taxable year. And with that said, that pretty much covers the big talking points with regard to maximizing contributions and what you need to be aware of, especially for small business owners and other employees of companies that maybe have small employee bases. Be here for a few more minutes. Anyone that wants to type in any questions, please just type them into the chat box. I'm happy to, field any questions. If one pops up that you think of later on, please feel free to email me. My contact information is right up there. Or give me a phone call. I'm here till Thursday. We are closed on Friday. So please feel free to reach out and let us know how we can help you.